Good afternoon again. We're still waiting for some participants to join in, so please give us a few minutes. Please be patient. Thank you so much. Well, good afternoon again. My apologies for the wait of a few minutes. We had a lot of registrations, which we're very happy about, but it's taking some time for everyone to log in. I'm Meera Parashuram. I'm very happy to welcome you to today's webinar on Wealth for Women, brought to you by IEEMA's Women in Power chapter and by the team of Prabhudas Lilladher. The stated aim of this IEEMA chapter is to provide a structured network that can support and mentor women professionals, primarily in the power sector, but also in other fields of work and even of those taking care of the home. The issues that women face are common, and we are no doubt greatly strengthened when we come together to address these issues and to resolve them successfully. Today's webinar is on the very important topic of money. It is an unfortunate and maybe an unwelcome truth that while we have been working and earning for several years, maybe even decades, we have seldom taken charge of our own money. Decisions on savings, investments, however small or large, are left to others. Many times we have not bothered to engage even with the topic of money. We have not bothered to educate ourselves about how to invest, how much to invest, where to invest, and how to make our money grow into wealth. Many times we may have wanted to know more, but the best of spouses or fathers or other males in the family may have told us not to bother, and we gave up, we let things slide. Some of us here will be engineers, perhaps, making the most complicated of calculations. We may be educators or doctors or managers, business owners, who are saving money for the companies that we work in, or we are saving money for the house. But we have neglected the basic tool that will empower us the most, and that is engaging with the topic of how to manage money. It is certainly the right thing to do to learn how to manage money, both for the family and for oneself. It is the right thing to do to have earnings and investment goals for ourselves. It is the right thing to do to devote more time and attention to educating ourselves and to staying on top of the money game. We're very lucky that we have here today with us Ms. Amisha Vora, Jt.MD of Mrs. Prabhudas Lilladher, who has agreed to conduct this webinar for us. She's a renowned expert on the topic. I'm sure that this webinar is going to be a very good start for those of us who have not yet engaged with the topic. Many of the people I spoke to invite them to attend this event told me that they were novices and do they need any prior learning to attend? And I said, no, it's going to be a good start, even if we have not actively invested. And I'm sure for those of us who are already investing, this webinar is going to turn us into savvier and better prepared managers of wealth. I would now like to hand over to Ms. Sonal Gariba, a committee member and also vice chair of IEEMA's cable division, who has organized today's event. Sonal, please introduce Ms. Amisha Vora to the audience. Wishing everybody happy learning today.
Thank you, Ms. Meera, for the welcome of the guests and nice roundup and summarization of today's event. I'd like to just add a further bit out there that in today's rising economic cloud of women, I think over the last half century, women's roles have evolved and changed rapidly. Not only are women generating an increasing amount of wealth, they're also directing the economy itself, actually heading up major corporations, pivotal and political and financial roles. Data shows that globally, women hold 30% of all wealth controlled by individuals or families. In spite of all this, and while strides have been made, women still fall behind men financially in terms of investing and retirement savings. So, yet, though financial security for a woman is of tremendous importance, yet most of us fail to independently plan to ensure a long, financial, secure life as demands of daily life take the toll. Our guest speaker, Ms. Amisha, is going to address this concern for us today. Ms. Amisha, the Joint Managing Director of Prabhudas Lilladher, as Meera already introduced. She's one of the leading women entrepreneurs in India today, a highly sought after opinion maker in the equity markets. Amisha regularly features on leading business channels for her views and insights. A dynamic and influential woman and strong proponent for women empowerment, Ms. Vora has won many accolades, such as one of the 10 most powerful women rising star by Business Today, Women Achiever of the Year and Business Leader of the Year from World Leadership Council in 2021, the Economic Times Most Promising Women Leaders 2021, amongst many others. I must admire her passion for this subject. Even in her busy schedule, today she is traveling and currently in Hyderabad, but she has specially removed this time to conduct the session herself. Thank you so much for that, Miss Amisha. We now invite Miss Amisha to empower and educate us on the best ways to fulfill our financial potential.
Thank you so much, Sonal and Meera. And as what you said, this is a topic very close to my heart. So thank you for giving me this opportunity. Thank you all wonderful women participating in this seminar for taking out time, middle of the day, maybe on a working day for this. This gives me so much happiness that you want to learn about this. So I always say my profession is to make your money work for you, because you work to make money and I make your money work for you. And leading to that, to motivate you all and also to empower you all, I'm going to touch upon some of the key concepts which are important to start this journey. You know, they always say that there are two literacy which is to be monitored. One is the literacy rate and second is the financial literacy rate. And India in general also, in terms of financial literacy, is far behind. Women have to be even more work harder to get onto this, but a beginning at any point is very important. So just to take things forward, what I'm planning to do, Piyush, can you please change the screen? What I'm planning to do today is divide my today's session into importance of goal planning. Why? While looking at goal planning, inflation is the critical factor, and then how to beat it. What are the suitable wealth creation strategies? And in understanding that wealth creation strategy, understanding the nature of each asset class. And for those of you who are really ahead in terms of curve and want to know a little more intricacies, I have kept just a few couple of slides on market outlook and economy outlook. To move forward, it's very important that for any small to big exercise, we set our goals. If our goal is just confined to finishing our chores, completing some timeline and deadline, achieving some titles and positions, then somewhere we are missing out as to, apart from getting the satisfaction of work itself while working, we are also working for our freedom. And that's most important. And for working for our freedom, which means not only with time, but with money, we can plan our vacation. We can plan a comfortable home. While we are busy working, our kids' education is also planned, as also marriage, and so also our retirement. We need to keep some goals. If we don't have goals, and if we keep just working, we will not go or reach anywhere. Some of the financial goals need to be set. This is very, very critical. So some of you who have not really thought through on this definitely need to sit down. Whether you are at 25, 35, 45, 55, you need to really sit down and chalk out a little bit of your next, even if 55, next 20 years. Once you start visioning your next few decades or years, you realize broadly how the time is likely to go and what would be the critical goals for you. Once you start envisioning those critical goals and you pen it down, then comes a sense of responsibility as to what are we going to save for, but not only save for, and what should our saving, what kind of returns it should generate for us to reach our goal. That is the crux of entire financial planning. This a professional woman needs to do for herself, but if someone is not working or earning, they really need to learn this because they can be contributing to their family. So while in this journey of wealth creation, important aspect is that our capital should not get eaten away into unplanned things. So I always emphasize that first thing in this journey is to safeguard or protect unexpected expenses. And for that also, you need to do a small planning, which means you don't only need to plan for your life by way of your life insurance or for your family's earning members' life insurance or for your young children's life insurance so that they benefit a lot by paying very small premium now and reaping large benefit in the future. But most importantly, you also plan your health insurance, because otherwise some of the unexpected expenses will just take away your savings. The whole exercise of converting your savings into your wealth will just get distorted if you have not planned your risk well. And so also you need to plan for fire insurance, home insurance, so on and so forth. So insuring yourself is the first step in financial planning. Now, let us understand why we always say there is a huge difference between savings and wealth creation. Why it is not sufficient to keep, let's say, 30 or 40% of your salary or income into a bank account. Why it is not enough, taking up fixed deposits? Because between your savings and your purchasing power lies a huge enemy, what we call as inflation. Now, this chart just shows you that if there is just 6% inflation, now what does inflation mean? Inflation means that 1 kg of a tomato, 1 kg of a dal, children's school fees, our clothes, our branded goods, our travel, our vacation, wherever we spend, the prices of everything just keeps going up every year. So whatever I think will cost me about, say, ₹1,00,000 today will cost much more because of inflation, say 2 years down the line. Inflation is a very natural phenomenon because all of us, we love our salaries going up. Now, when our salaries keep going up, the cost of production across just keeps going up. So this is a cycle. And if we don't budget for a 5 to 6% inflation, imagine something which you think that 20 years later, you need to do particular expense, which now costs just about 5 lakhs. But if you are not mindful to realize what it will cost 20 years later, it may just cost you 20 lakhs. And once again, you will be insufficiently prepared. So that's what we call that the savings into fixed deposit is not enough because it does not keep your money equivalent to your today's purchasing power. With a 1 lakh or 10 lakh or 1 crore, what you can purchase today, but you don't purchase, you save. So 3 years later, when you want to spend it, this 1 crore should have grown enough so that your purchasing power is same or in fact much, much better because you restrained your consumption need and you saved. So that is why we need to very thoughtfully channelize our savings into different asset class to beat inflation and create wealth for ourselves. Hope this concept is found useful and clear. Just coming up with a quick poll just to gauge where do we stand. Can you all please participate? The poll outcome seems extremely encouraging. And let it continue for a minute more. But I can see that professional outlook to life has made so much difference that almost 81% of the women participants are saying that they and their family are adequately insured for life and health. That's extremely encouraging. But when I see also the percentage that are we preparing our family's financial goals, and regularly 52% of the women feel they do, and that also is really encouraging. And that leaves a good excitement and encouragement for the rest who are not doing it. So I must congratulate that a good number of people have done their insurance, and to rest who have not paid attention to it, it is extremely clear that this is one of the key priorities. Shall we move forward? So now to beat inflation, in our journey to convert our savings to our wealth, our choice and our freedom, we came across an enemy called inflation. And to beat that, what we have and what we call magic of compounding. If you see the illustration, it says that on a 10 lakh rupees investment, if you take 8% simple interest, it takes 50 years to make it 50 lakhs. So in 50 years, the amount will become 50 lakhs. But the moment that is compounding interest, which means on the first year interest again added to the original sum, you earn another 8%. Then on that total sum, you earn another 8%. And you keep on doing that for 50 years, the total sum will be 4 crore 69 lakhs. So one is 5x, one is 47x. So this, as what in the financial world, we call it magic of compounding or world's eighth wonder. And this is what we all need to harness. I'm sure most of you know this. We women are typically good at it. Sometimes I find that the youngsters, millennials, feel today is the most important day. But even to them, I would say that a wise, financially literate person takes decisions as per the second box, which is income less savings is equal to expenses. This age-old saying that our needs should not be so high that we have to sell what we need. So we need to plan first and foremost from our income savings. Only the balance is available for expenses. That itself will put a great piece to our life. And then starts the journey where we take our savings through right investment products, giving us compounded returns and create our wealth. I will quickly touch upon the important investment options, their pattern or their type, and more about the nature of return. Most of us and all of us know gold because most of us are in love with gold. From age old, gold prices has been going up. It used to go up before because there is finite stock of this yellow metal in the world. It goes up more now because while the world has come out of gold standard, which means you can print only as much money as the gold that you have. We have debased that, but after debasing, we print so much money without equivalent production of goods that gold with its limited stock continues to rise in value. Gold in its normal physical form do not give us any fixed return. But now there are smarter ways of investing in gold also. If we take second asset class, which is real estate, most of us, we are aware of it. We all always have a desire to own our own house, own holiday home, and then go further, and we find it simpler to have one more house and give it on rent. In the process, what we don't understand is that the house price inflation over a longish period has not been higher than core inflation. Yield or returns on housing investments, if you see the rent, is not more than 3 to 5%. And it is illiquid. You can't overnight encash your real estate, be it in land or in other property. Art, of course, is an important asset class or investment, but not extremely well known in a larger population. But yes, ultra HNI and HNI definitely need to use this asset class also. Cash every day loses its value. We need to remember this for sure, so that cash is always converted into any other equity asset class. Then comes debt stroke fixed income, which means typically your money will continue to generate a particular fixed return, which we call it interest or coupon, ranging from, depending on different instruments, 3-4% up to 9-11%. We always say that this is completely risk-free, but it is not like that. Except for government bonds or public sector banks, most of the other fixed income instruments also carry the issuer's risk. Then comes the last asset class, equity, which we participate in many different ways. Of course, direct equity, through mutual funds, through portfolio management services, through alternative investment funds. And if we are even more evolved and want to take a little more risk, we go into angel investing in startups or venture capital or private equity. But equity necessarily means that it is not, the investment is not supported by any hard asset. Bonds are typically supported by hard assets. Equity is not supported by hard assets. There is no obligation for the opposite person to return this money. The best part of equity is it is very liquid. And because of that, it has a lot of interesting features which should be harnessed. So this is some of the points I already mentioned. The difference between real estate and equity. One is highly illiquid, one is highly liquid. So in equity, the price is transparent. Nobody can fool you around on a listed equity as to what is the price. And if you sell or buy, what price you will have to pay. In real estate, a lot of negotiation will always remain. There is a reckoner price, but there is always a discount to a reckoner price or a premium to a reckoner price. Real estate requires maintenance, equity does not require. Once you put it in your demat, it's there. Real estate could have legal issues on title, equity, legal, no issue on ownership. The title is always absolutely clear. I'll take a few further points and then dwell into equity once again, little more. Same way I was telling you, the physical gold, when we invest, there are certain disadvantages. For example, the risk of theft or storage issue. There is a capital gain tax. There is 3% GST while you buy. But if you are a little bit savior, smarter, and you plan through these sovereign gold bonds, you enter the bond at today's equivalent gold price. You start getting 2.5% interest. And at the end of the period, you get that day's equivalent gold price, which means that you participate in entire gold's appreciation or depreciation, we don't know, but you simultaneously keep getting interest. So when you want to plan for your any family weddings, gold, for daughter's marriage or etc., this is a much better instrument to plan your gold investments. And there is no GST. Imagine a 3% saving on GST and a 3% annual interest itself is a difference of 5.5 to 6%. just once again to evaluate these different financial assets into risk metrics so that you understand the difference much better. When you want to just preserve your capital, there are times when the world goes through tremendous uncertainty, and because of which the other asset classes might correct or fall. Those periods or any other exigencies or planning that you're going to do an acquisition in some time so that you want to keep your money intact. When you want to take very low risk, then you invest into money market funds, short-term deposits, or government paper. Because in all these three instruments, safety of money is absolutely 100%. When you go to medium to low risk and you want to generate some income on your investments, which is higher than money market funds, you go for bonds, fixed deposits of corporates like fixed deposits of, say, M&M, fixed deposit of HDFC, not only bank fixed deposits, I'm saying fixed deposits of corporates. Then you go for AAA, AA, single A rated bonds based on the safety that they offer, the interest rate or coupon on that changes. When you want to take a long-term view, medium to long-term view, and medium to high risk, you start investing in equity through different modes of equity participation, which I just explained sometime. Why do we say that equity is little high risk? By buying equity, you are becoming partner in a business. Any business has its own inherent risks in terms of the business cycle, product cycle, cash flow cycle, or the basic economic cycle. So all those risks we take. Over and above that, this equity shares, we buy or participate at a price. And that price is determined by a number of factors, including the amount of money or liquidity that is chasing that stock or that business. So when a lot of money is trying to buy a particular share, portion of that business, the value or price at which you get that share goes up. So in equity investments, a lot of skill comes as to which business to participate, why, what price to participate, why. So it is with all the due respect to all of us who are full-time professionals, still we always make our decisions based on certain future assumptions, and we change our assumptions based on actual reality, the way it pans out. So equity investments are liquid, which means that itself as a factor should not deter us because the price just keeps going up and down and we keep focusing on price. No. But at the same time, the business also keeps going up and down, and we need to have a focus on that so that at a right price, a combination of business cycle and price valuation, we invest and divest. But there is no asset class which can give, please take it for, which can give return as the asset class of equity. So here is a quick chart of what returns do we get in different asset classes. Your saving bank account is eating your money every day because inflation minimum is 6%, but when average inflation is 6%, most likely the things that we consume go through 10 to 12% inflation. So this 3.5% at which your money is lying, your purchasing power every day is diminishing. tax-free bonds are at 4.5%, but once you club the tax, so it is say 6%, just meeting inflation. Then starts the rest of the things like corporate bonds or debt mutual funds, where you start gradually beating the inflation, and equity is the only asset class which helps you meaningfully beat inflation. Next, Piyush. This is an interesting rule in financial world, so I will just introduce you all to that. We call it rule of 72. What it means is that by dividing 72 by the annual rate of return, investors roughly estimate how many years it takes for their initial investment to double. So if you see, it will take in bank FD 15 years to double. And well-managed equity investments will take 5 years to double your money. So the whole need to be financially literate, take professional help, and diversify your portfolio. Another extremely beautiful concept I want to introduce to you all, either for your own selves or for your children, is early age has huge impact on wealth creation. Like compounding and starting early are the two basic principles of wealth creation. If you start at the age of 20 years, you have to invest just 51,000 rupees a month. Okay? And you achieve the goal of 60 crores at the time of your retirement. If you start at 30 years, the amount becomes 1,70,000 per month to achieve your goal of 60 crores. And if you start at 50, you have to invest 26 lakhs a month to reach your target of 60 crores a month. And that's why the importance of SIP, systematic investment plan. And that too, particularly if it is for your kids, equity SIP. Once you put it into place, you don't have to worry about the ups and downs of the markets because it's for long term. And in the long term, India will grow, economy will grow, markets will grow, companies, businesses will grow, and so also our equity investments put professionally into equity SIP. Don't say that you put it into 3 particular stocks and it didn't go anywhere. I'm not advising that. Equity investments has its own set of rules in terms of regular monitoring. But I'm saying as a product and instrument, equity SIP is a must to achieve your wealth creation goals. Let me know how many of you want to be 50 or 100 crore patis instead of patnis, patis. Okay, what's the poll? Let me understand. Do you have any investments in equity shares, mutual funds, PMS schemes? Can you all please give me a little feedback? So if we see, one good highlight is that 65% of the people, or 66, have exposure to equity mutual fund PMS. But then in second answer, I am getting most of our family's investments are in fixed deposit, and 51% say that it is true. So hope at least that part of the audience realized that how criminal it is to keep piling up fixed deposits, because that's not helping you to keep your purchasing power even same. You know, Piyush, for next time, I don't think we have that slide here, but do keep this in mind. I want to show that gold's return also. You haven't plotted probably gold return. So simple investments from fixed deposit to gold bonds would also do you so much justice. And so also investments in bonds. If equity is a fear, but we will try and remove that fear. Sure. So that's where we stand. So as what all of you realized, that the real challenge lies in increasing our returns, which means creating the delta between the returns and inflation. And one of the key instruments which is going to help us do that is equity. That is taking a little more risk for a little higher returns. Once again, this is very basic that I'm explaining here, that how equity has to be participated. When we say direct, is by actually opening your Demat account and taking shares. When we say indirect, is giving the decision of which stock to buy to a fund manager, be it mutual fund manager or PMS and AIF advisory baskets, etc. So yes, I will definitely touch upon this, how to select a fund manager, but it also depends. First, you have to have a view on how to select a stock or a equity. So I say the principles are very basics. When we always keep hearing corporate governance, what do we really mean by that? The basic principles of life doesn't change, whether in terms of marriage, whether in terms of our any other life decision, so also in terms of investment decisions. Whom will we partner? We will partner first and foremost to someone who is transparent. And what does transparency mean in terms of financial markets? They will project, because when we meet in person, we see each other's face. How do we see a company's face? By way of its balance sheet, which means that in the balance sheet, the real numbers are projected, be it in terms of their sales, be it in terms of their profits, be it in terms of their debt. A company is seen, the beauty of a company or a business is seen by way of its balance sheet. So when I can trust that balance sheet is when my decisions can become right. So first, in deciding equity investments is always selecting a stock where the management quality in terms of trust and transparency is highest. Second comes management quality in terms of their ability. Third comes, together with this trust and skill, what opportunity this business is chasing. What is the story? Story meaning, what is the opportunity or market size that they are trying to address by way of their products or services. And in doing so, what competitive advantage do they have? If they are just a me too, why would anybody select them over others? And if that moat is missing, why will they have extraordinary margin? Or why will they have extraordinary, the last statement, return on equity. So equity investor always chases business which generate in the business highest return on equity, which means to do a business, say I invested 100 crores or 10,000 crores. But by investing that, what returns, what profits I generated, that profit divided by that pool of equity or reserves that is in the business is called return on equity. That is the ultimate guiding factor which businesses strive to achieve. Because when your return on equity are high as compared to a debt instrument which generates say 6%, I take that extra risk in investing in equity to chase that extra return that the business is generating. So to a 20% return on equity company, we give thumb rule, I'm saying 4 times book. To a 40% return on equity company, we give thumb rule 10 times book, because the base return is what, say 5 to 6%. So if they are consistently generating such high return on equity, book meaning what? Net worth. And so market price divided by net worth gives us book multiple. So there are 2-3 things involved in equity investments. One is understanding the business and quality of management. And then, as what I said, valuing it and making sure we are getting it at right price. So if you don't invest a particular amount of time regularly, you should not do this injustice to your own savings and leave it to professional investors. But in choosing the right fund manager, you have to see the blue blooded fund managers will always give emphasis on quality of management and moat in the business. So just to say, Axis Mutual Fund has consistently been investing in some of the best quality businesses in India. And what happens because of that? When markets go up, a lot of money chases that good business. So the fund performs better. When market comes down, these businesses are solid. Economy comes down. These businesses are solid. They bounce back faster. And so the fall is lower, but the rise is higher, which is what equity investments have to strive to achieve. So this is all about investing, choosing the equity, the broad parameters, and based on that, choosing the fund manager. The other side is trading. So first principle in trading is that you are buying based on certain trigger, that this company will post very good results. This company will have a strategic tie-up. This company will have so-and-so. But if that news does not come, what you really need to do is put a stop loss. Trading, the first fundamental principle is to put a stop loss. That if the direction changes, you are not just sitting and watching it because it was your trading call. You didn't do what is written on the right-hand side, all the detailed analysis to arrive at the decision to invest. You did a quick trade based on certain information. If that information is not turning out good, better book loss, be ready with your balance money to get next opportunity. So the two styles are different when you deep dive into equity. When you don't do it directly, you hand it over to a seasoned investor, and to check that, you always check long-term returns, because some fund managers might do very well in short periods, but consistently who does better is what is to be looked at. One of the funds, of course, I said, which I admire a lot because of their investment strategy and their investment frameworks. Can we move forward? This chart I am bringing out to tell you all that market volatility is because of the liquid, the way market is. We cannot get, we cannot lose our sight in the long term for the short-term volatility, because as you see, so many phases in the market came. Great bull run, of course, between 2003 to 2008, followed by global financial crisis, and followed by the COVID crisis. Despite this and many more such events globally, commodity shocks, geopolitical risks, so on and so forth, on an index basis, market has consistently given very good returns. And what does index mean? It is a combination of about 50 stocks, if we talk about Nifty, in weightage of their free float. So the best of the companies only enter into Nifty. And that has given this kind of compounded returns. But meaning 100 became 115. On the 115, again, we got 15% return. So the simplest way is also at times to not keep your sight on short term and get frightened because of the volatility, but keep long-term vision intact. Correct. Now, to specifically address the need, can you take forward? To specifically address the need, there are two approaches to investments. One is we look at the individual's risk profile, which means that I can't sleep if my investments goes down by 5% because the price has come down. But I'm quite okay because I know that the business is doing very well, and in 1 year, the business will be better than today, and my investments will keep going up. So I have a nature. So investments is not only financial, but it is individual based also. The individual's risk profile based on their emotion, nature, understanding, and knowledge, also based on their goals in terms of generating regular return or keeping it for long term. As a balance of this, generally an investment strategy is decided for individual clients. But we have taken a very different approach. We want to not leave decision on which asset class when to your maturity, your emotional stability, or your knowledge. What we are proposing is, particularly, this is, we call it Wealth for Women portfolio, which is a combination of different asset classes, but the decision of which asset class, what weightage will be there, is dependent on the understanding of the quant model or strategy, which means that generally we advise clients to invest X percentage in equity, Y percentage in gold, Z percentage in bonds to match their risk return profile. Here we are seeing that we don't want to depend your returns on your understanding. Let your returns depend on the strategy's understanding of market cycles. So across these asset class, as you can see, domestic large cap equity, domestic mid cap equity, international equities. Why international equities? Because otherwise than that, you don't participate in what's happening in the world. A Tesla, an Amazon, a Google, a Facebook, we are not participating. We are using it, we are paying them, we are not participating. So international equities, I consider, is a must. And most of us have that LRS limits of $250,000. Then there is gold, GSEC, corporate bonds, and liquid funds. And all these asset class, we allocate based on our internal proprietary models through ETFs. And by investing through ETFs, we avoid totally the risk of any particular business cycle, management quality, etc. Because ETFs represent indexes. So just to introduce you to one product, there are of course many other good and products in the market, but we wanted to make this a bit more specific. So I have chosen this because this is one of the pet product we have created for women. This Wealth for Women portfolio, if 100 rupees is invested, this is historical back-tested results for 15 years. By tactically allocating weights or changing weights across different asset class, generated 2,700 rupees. While if you would have just invested in, say, Nasdaq 100, it would have become 1,400 rupees. If you would have invested just in mid cap, it would have become 6 times. 100 would have become 668. If you would have invested in large cap, 100 would have gone 5 times. In gold, it would have become 4.5 times. In corporate bonds, 3.5 times. In 15 years, I am saying. And in gilt funds, it would have gone to 350. So individually investing in any asset class would have given you these returns. But by tactically shifting between different asset class through ETFs, it generated 27x returns in 15 years. So a 1 lakh invested 15 years back would have become 27 lakhs. And you would have remained in all the different asset class. So to look at a balanced approach, this we thought for women is a good starting. Having touched upon some of the key concepts in the financial market, which is having a goal is a must. After having the goal, securing your savings is the second must by insuring yourself. Then that savings itself has to be again secured from inflation by putting it into different instruments or asset class. We touched upon the nuances of different asset classes, suitability and its strength. And lastly, we touched upon the one particular product, which is a combination of this asset class, playing it tactically. Now for those who are already invested in markets and understand markets, particularly equity markets and economy pretty well, I'll just quickly touch upon this before I end my session. So I say that, and you all would be definitely knowing, being in the business, that the biggest advantage today is that India is the youngest nation. Youngest nation advantage is that more number of people are in earning age than in retirement age, or children to both the other classes, that is retirement age and children, we have to feed while the earning age earns. That's the biggest advantage of our nation. And to harness the potential of this young educated class, as we all see in last two decades, and particularly in last 1 decade, we have as a nation undertaken many reforms. So the 4 key themes which are emerging in the largest, one of the most populated and youngest nation, and that too a democracy, is formalization, digitization, urbanization, and financialization. Now, all these four themes, when they come together, formalization helps report the right growth. And when you report all your earnings and pay your taxes, by paying taxes, not only the nation grows for its infrastructure need, gets the right money, you yourself become able to borrow money. So these are some of the key themes which are helping create a virtuous cycle in Indian economy. I say digitization also creates a virtuous cycle because not only UPI and Aadhaar and so on, but today a lot of demand is created across India when with this fiber people use phones and they see on Instagram so and so is wearing this nail polish and that lipstick and that haircut and that cloth, they get their desires. There is a demand created for this, and because an Amazon is supplying them on virtual platforms to distant places, the demand is fulfilled also. And when demand is created and fulfilled, economy grows. So this is one of the very critical pillar of our economic growth. Apart from the financialization, which helps make payment across, like UPI is so critical. You can make payment anywhere, anytime. And last but not the least, the urbanization. When you make roads, when you make airports, you give employment to so many people. In turn, they spend in the economy. And once created, we start traveling, we spend. So the spending and creating are the two critical factors which gives growth to the economy. So in my opinion, first to talk about the economy, in last 7 years of the current government's regime, we underwent a lot of reforms, from demonetization to GST to banks cleanup and NCLT rules and so on. Because of that, the economy was not getting the right strong push to grow, and banks were not so willing to lend, and money supply in the economy was choked. As we stand today, COVID has played a great role because the RBI and government has loosened the purse, and they've loosened the purse at a time when all the reforms are already in place. So there is no disturbance. And now the full focus is on increasing production in India. So we are declaring so many production-linked incentive plans across sectors. When you give those production-linked incentives, the corporates or entrepreneurs want to invest. And that is also aided by the fact that China is being now fraught by most of the global players because of the inconsistency and over-dependence that other countries have on China. So I believe that India's manufacturing will benefit a lot. India's infrastructure investments are going very strong, and GDP growth will have the best next 5 years. Once the economy is going to do very well, and there is this China plus one strategy as what I just explained. All this growth in the economy will reflect in earnings of the company. Please change, Piyush. And let it continue. Please change. Please change. I covered this. I'm not going too much in detail. Correct. So when all these factors are playing in the economy, the companies, the large companies benefit, their earnings grow, And I must tell you all that India is the most tax rate effective country in the world now, because any new company set up today and capital expenditure made will attract only 15% tax. And otherwise corporate pay 25% tax. So that's very, very competitive tax structure. And last point I will say in the economy is that we all know for last 10 years, residential real estate prices and demand were going nowhere. But after all that dull period, the final revival has started with very low interest rate, almost lowest in 2 decades for housing loan. Fact that the prices have not moved up has resulted into as what we call affordability index. So now in India, affordability index is at 3x from a peak of 22x. So about 15 years back, 22 times of your yearly salary was the house price for an average Indian. Now it is just 3 times. So residential housing boom will continue. In turn, the demand for tiles, wires, fans, furniture, paints, etc. will continue and keep giving huge support to the economy. So in short, the economy will continue to do very well. But when we talk about markets most of the time anticipate some of these things. Piyush, can you please change? Thank you. And so markets would have taken a view on these developments pretty much in advance. So why I'm taking this very technical thing, I see keep reading some of the questions, but I'm taking a slightly technical part also for some of those who are really investing in the equities, and it might just be of interest to them. So just bear with me for a few minutes. So we measure markets. There are many ways, but one of the ways to measure markets is Nifty's earnings. So Nifty earnings for last 5 years grew at a CAGR of just about 6%. And for next 3 years, we expect it to grow at a CAGR of 22%. So we expect EPS of Nifty companies itself to be at 840 rupees. And there is always a multiple which one gives to arrive at index value. So this gives you Nifty targets. Now, so many assumptions and everything comes into arriving at this. And also, it is always reviewed. So don't just go by this, but as of now, as a research house, this is our view. That this could be the base case scenario, 17,000 or so. This could be bull case scenario. And the fact that economy is likely to do very well, but sometime in next 6 months, we will head towards global central banks continuing to reduce their liquidity in the system. We might encounter a good amount of volatility in markets going forward. Piyush, next, please. Okay, these are just some of the themes I have mentioned. I will not elaborate because I want to leave little time for question and answer. Please go ahead. So this just last thing, if you cannot control your emotions, you cannot control your money. Do invest little time in thinking through this, and all the things which I said will fall in place. Thank you so much. And now I would like to take a few questions if you all think right, and hope this made some sense for you all. Thank you.
Thank you, Ms. Vora. Amazing session, beautiful insights, right from choosing the portfolio right to choosing your right manager. some of which were real eye-openers. And in a short time, you have kind of touched upon everything, very nicely captured the importance of goal planning, the prioritizing of insurance and health over other things. Rule 72, that was interesting. And of course, deciding the diverse investment baskets for our wealth growth. So what we'll do is we'll straight away jump to the questions. Everyone, whoever would like, can post their questions in the chat box. I can see there are quite a few already there. And with your permission, I'll just shoot them off at you. So going in order, could you suggest options to park emergency funds? This is one of the questions which has come up.
So emergency funds, which means you can withdraw anytime and it is not depreciated, generally can be parked in fixed income instruments only. That you cannot park in equities. Fixed income instruments, safer are AAA or AAA bonds or corporate deposits. So where there is no lock-in period. You know, in case particular names are required, Piyush will help that.
Right. Satishji, I believe your question was already answered by her during the thing. How does one select for the fund manager? Ma'am, your take on future trend on equities in the next few months.
So I did cover that. That I feel economy will do very well, but markets will continue to be a bit volatile. Because of the fact that there are lots of IPOs coming. And for investing in those IPOs, mutual funds have to sell the existing equity. So the existing equity markets will have little pressure. FIs are not very aggressively investing at this point. And beyond this immediate cycle, we also probably will see that Fed at some point will start receding its huge pumping of liquidity. So markets will continue to be volatile.
Right. You spoke about SIP during the session and SIP at an early age. But the core question is, how do you inculcate that habit amongst the children? Habit of saving.
So it's like this. For till the time they become of earning age, it's the parents' responsibility to plan their future. And it's up to parents to first start SIPs for their children. And beyond that, when I'll go back to basics, and I think that helped my family. So dinner time, you can discuss many things. But sometimes at dinner times, when you discuss openly with your young children also, your financial planning, that's when the children learn the importance of saving, wealth creation, investments, rather than Insta, shopping, partying. Of course, apart from that, they are all studying, I know, but rest of the things they catch up. But here we have to create that environment. And we have to discuss that openly. And we don't have to, frankly, once you initiate them, they do so well because of the social media exposure. They go on YouTube, they go on Google, they find out the best that needs to be done. They learn so fast. So I'm extremely proud of our millennials' ability to understand once they are initiated. And that responsibility of initiating depends a bit on the environment that you create.
Right. So we started for them and they learn and they grow from there. Are there any additional incentives by government for women investing in bonds, infra, or capital building?
As per my knowledge, no. Senior citizens do have certain advantages, but I don't think women have.
So that's the next question. In fact, what about senior citizens apart from PPF funds, which they have said? Are there any other lucrative bonds apart from gold bonds or PPF funds?
No, advantage is there in only few select instruments, which you mentioned. Piyush, in case you want to add, if there is wherever there are senior citizen advantage, can you please quickly add?
Yes, so there are a couple of products which are specially designed by government, like Vaya Vandan Yojana and those kind of senior citizen schemes. They are offering slightly better interest rates with slightly low lock-in
Can you name
periods.
them? Do you know that? Can you name them?
So it's a Pradhan Mantri Vyakti Vaya Vandan Yojana. I'll send you those stuff, separate.
Okay.
They're long headings.
Okay.
You can, if you want, post it on the chat here, so then
Sure.
people can get access to it.
Perfect.
But that gold bond, somebody is telling share. Piyush, what is the way, and rather Sonal, what is the way to tell them where and how to invest in that gold bonds? I think it's a very basic but very powerful instrument compared to actually taking gold. Because somebody is just asking that question, so do facilitate them. Frankly, I know that, Piyush, do you think our website has some exposure on reading and how to invest on gold bonds?
Yeah, we do have a couple of blogs on sovereign gold bond.
No. Actual ability to invest.
Okay, yeah, we have a couple of videos which we can send it to the group and then they can circulate.
Sorry, my question still is, if somebody wants to buy this 2.5% gold bond,
Yeah.
what are the 1, 2, 3 steps? Quickly, because one question was there.
So
They
you'll have to
open a
open,
Demat account?
you'll have to open a trading and a Demat account if you want
And then
a broker, or you can also buy it through the bank. A couple of commercial banks they also offer.
perfect.
Fine. So taking that, so any specific investment schemes beneficial to women? Of course, you mentioned one, but apart from that,
No, there are no special advantages as such, but only way to look at things is that women may find limited time, limited networking to be in that, where you can keep discussing and knowing again and again. Men, why as an advantage? Because they network, so the information flow just keeps coming. And then their decision making is also based on that. We always say, environment creates an impact. So women generally have that less exposure in such discussions. So we said that there is a product which goes across asset class. But everybody at the evening while traveling back can go to money control and read up a bit. Once you do that, you will be so smart enough to, interact with the guys, and they'll be pleasantly surprised.
yeah. So like we do in the other fields, this will help us to
Absolutely.
speak to them on finance and markets as well.
Because see, the biggest advantage women has, I believe, is that we are very sincere. As a tribe, we are extremely sincere. If we decide we will read, we will not just open the phone and do something else. We will read. So we will understand. And when we understand, we can implement.
So that brings to the next question. Is investing in debt funds and then doing SIP to Nifty is a good idea instead of FDRs?
100%. 100%. I said that if you keep money in FDRs, you are doing a criminal injustice to yourself. You have to learn and beat inflation for sure. And if you put it in bonds, you can definitely withdraw when you want. But it's because you don't know which bonds are good. What does AAA rated mean? AAA rated is giving me what interest? What bank FD is giving me interest? You've not taken time out to know this. So take out little time. And SIP into Nifty will definitely be a good idea. But I will... Yeah.
So in that case, if somebody wants to know more with the help of a broker or with the help of a fund manager, they can of course reach out to your group, right?
Definitely they can. But I will just conclude here one more thing. To suppose you do a Nifty SIP. Okay. So I just explained, by just doing Nifty SIP, probably now Nobody knows future, including me. So I always say my opinion can always be wrong. But you do SIP now. And say for the next 1 year, there is some geopolitical crisis and markets take a 25% beating. Okay. But you will continue to do that SIP. For long term, it is good. But for your better wealth management, participating in Wealth for Women portfolio, which is digitally available both on Small Case as a platform and Welldesk as a platform, is much smarter because somebody behind will decide right now you should put in equity or just stay away from equity and put it in debt. We take that decision based on whether we think a lot of risk is there in equity, then we just take a shelter in debt. So both this needs to be balanced. But yes, for children, if you want to put SIPs into Nifty, please go ahead and do it. A 10-year period Nifty will always give phenomenal returns.
Right. One last question, which comes from Bharti. My 16-year-old son asked me that where he should invest his savings except his bank account, as he wants to start at this age and before 18 years, he cannot do so. He says Bitcoin or gold. Please suggest.
Bitcoin. He should invest in Bitcoin. That's the future, by the way.
Okay, so there are a lot of more questions. I don't know based on your available time. Otherwise, we can kind of...
one more we will take or two more. 4:30, I have one more call. So if that is okay with you all.
Yeah, that should be fine. So people have asked for your... yeah, okay, there's one more question here which says that for a first timer, your precious mantra in investments.
So I always say that in investments, what makes a difference is review. And that means that I arrive at a particular decision based on some thinking. And then I review it at a frequent, at set interval. I just don't do it and dump it. That's where the wealth will not be made. Invest for long term doesn't mean that don't review. So one mantra which I say is review.
Right.
Not churn. Not churn. Review means reassess your investment decision framework as to
So,
I invested in bonds so and so, say Mahindra's fixed deposit or HDFC's fixed deposit. Okay. After 1 month, I'll see again. Oh, Mahindra and Mahindra, I'm sure they don't have a problem, but has this problem. So I should take from here to there. Or no, everything is fine. I stay put. But review is a must.
so basically, it's like you have seen the assessment of the company before you've invested. Maybe a month down the line or 2 months down the line, you want to revisit that and see that the company is really performing in that line.
The same, correct.
Continue there, or if not, then switch over to a better portfolio, which would...
Correct. Think exactly. Review is must.
Got your
And
point.
generally in 1 month, things don't change. But if we keep a habit of doing that, we always have, even if our conviction gets built further, we may invest more. But review is must.
Got it. Last question, PPF of NPS, which is a better retirement plan?
I leave that to Piyush. Your choice, your answer, please.
So PPF will definitely give you good returns compared to other fixed income products, but it has a 15-year lock-in. So whenever you invest, and it's a very good tax saving product. So those people who don't want immediate money, but they want to save it for retirement, since it's protected by government, they can all, and the restriction is 1.5 lakhs per annum. So 1.5 lakhs of PPF per annum is justified if you want to hold it for next 15 years. And on NPS, it gives you extra tax benefits over and above Section 80C tax benefits. So Section 80C gives you 1.5 lakhs of tax benefits. And over and above this, NPS gives you additional 50,000 rupees of tax benefits. So people looking for tax planning aspects, and plus NPS is not only fixed income product. Now they do have equity flavor. Couple of their schemes have market linked returns like HDFC pension scheme, and couple of these fund managers, they do have equity flavor in the national pension schemes as well. So both are good. I mean, based on your financial plan and tax plan, you can choose between both of them.
So based on whether you want liquid funds available at any given time, then you choose it. Otherwise, if you have a long-term plan, PPF is also a good option.
Yeah, but the restriction is only 1.5 lakhs per annum of investment limit. So
yeah.
Once you exhaust it, you need to look at for other products.
Got it. Right. So one more question, if you permit. There is a question from Surbi which says, when we should book profits if invested in mutual funds, or should it be for wealth creation for long term?
So that again is an exercise which has to be regular. And if you do regular review, then at times, yes, you can book profits in mutual funds depending on the market valuations, the other risks that are emerging on the horizon for equity as an asset class or business. But if you don't have that very skillful touch with the markets, then you keep it for long term, ride out the falls and the upsides.
Fine. There are questions still pouring in, but I think we'll just sum them up together and have it sent over for answering to Piyush.
They will definitely answer.
Yeah. I will now call upon my colleague, Arya Shrikant. She's a NEC member, IEEMA, to give the vote of thanks.
Thank you, Sonal. It's really a pleasure to be presenting the vote of thanks today evening. Ms. Amisha's session was wonderful. We can see the chat box full of praises for the session today. Madam, it was a very insightful session. Thank you very much for accepting our invitation and gracing our program. Women in Power is a new chapter that we have created in IEEMA, and you can see the kind of excitement that it has brought in amongst women. Generally, before attending this session, we all had a thought that, finance is a tough nut to crack. You made it look like, very simple. You gave us tips on how to do it. I know it's not that simple, but it's your, the insights that you already have that makes the whole session look so simple and doable. I think most of us will go back, reflect on whether we are investing right. And I think looking at the kind of response that we have got today, I think a lot of us will come back to you for more support and guidance. Thank you very much. Friends, we know that Madam Amisha is she's a busy entrepreneur. It's not easy for her to take time out like this and come and address this. It's only because of the affection she has towards women, and she wants to work for this cause that she is here today. Thank you, Madam. We will look forward for your support and guidance. This Women in Chapter, this whole concept was, it was a vision of our immediate past president, Mr. Anil Sabuji. He was the one who created it. He thought of, having separate women programs run by women also. So it's because of him. So I should take this opportunity to thank Mr. Sabuji also during this occasion. And our current president, Mr. Vipul Ray, he is also very encouraging. He says, what is your next program? I'm there with you. He supports us for all the programs. So I should take this opportunity to thank him. And Dr. Meera, I have a big list to talk about her. She is very proactive. She has all the energy. She wants only the best in class programs, be it whatever we are doing now or at first programs. She sees to it that we are on our toes all the time, and she sees that we deliver only best in class programs. So it's really nice that We have Dr. Meera chairing this committee. She has been extremely supportive to run this program also. And this program was Sonal's brainchild. So end to end, she has worked on this program. In fact, she conceptualized this program also. We have a lot more programs planned for this vertical, I should say. So thank you, Sonal. I think people who have attended this will personally thank you also. It was very insightful. Thanks, Sonal. And I have a list of friends who are, there always supporting us. One is Ms. Shalini Bajaj of Platec Industries. She's the CEO of Platec Industries. Varsha of Scope T&M, Dr. Shivani and Ms. Rekha of Hitachi ABB, Ms. Shreya of Mrs. PTCL. They all are there for all our programs. So they are very supportive. And then this whole operations team of IEEMA, starting from our Director General, Deputy DG, and the whole team, Gurleen and operations team, they all have sent mailers. I mean, the hard work they have done towards making this program this successful. I should thank them personally also. Yeah, so, and then this program wouldn't have been successful without so many members actively participating. Some of they have, taken time out on a working day and they've come registered for this program. So thanks to each one of them for coming to this program. Also, I should take this opportunity to talk about our other upcoming programs. We have a good lineup of programs, including some mentoring sessions, some specific programs for women in business, family businesses basically. And then we also have programs for motivation talks and interviews that we have with successful women. So there is a good lineup. I request all participants who have registered today to come and participate in our program, our other programs also. Take membership of IEEMA, specifically attend all programs of Women in Power chapter. It'll be very interesting to have all the women out there, women for women. It'll be a nice thing to do. Yeah, thank you.
Thank you everyone for your time, and thank you for having me here with all of you. And I hope the last poll will be 130 out of 130, all investing and making sure that savings are converted into wealth.
Absolutely. Thank you so much.
Thank you. Bye. Take care.
Bye.
Thank you.
Yes, ma'am. We may begin.
Wonderful job, Gurleen.
Thank you, ma'am. I was expecting more than 200 people. I mean, 291 registered, but somehow 138, I think, was the last count I saw.
I think that's pretty good because for Prarambh we had 1,000 registrations, but only 400 people actually attended.
Yes.
So I think this is wonderful. So what say all? Congratulations, Sonal. Went up very well.
Yeah,
This is for
Congratulations.
everybody to say, but yeah,
very good program.
yeah, it
Yes.
was
Excellent program.
decent. We could have, I mean, I had a little better,
Yeah.
I thought it was too basic. It should have had more elements per page. It got a little bit flatter in between.
But we didn't know the profile of the people participating, right?
Yeah. But of course, this just gives an idea to the next finance session slightly better.
Yeah,
Know
it's
the
a
participants.
step. It's a first step. Then you
Yeah.
can build a
But overall, good turnaround. 135 was not bad. I mean, considering
Yeah, that's good. We had 130
yeah.
connected at all times.
You need to mute yourself. Yeah.
किसी ने मुझसे कुछ पूछा? I'm sorry, there's a lot of noise around, so probably I missed.
No, I just said that whilst not, if you're not talking, that time mute yourself to do a lot of background.
Yes, there.
Much better now. Right, so
I think so. Your committee, your subcommittee, subdivision, excellent start. That's really very good.
it's come and gone. Yeah, some takeaways. One is I felt that the WIP logo, it missed out. I should have instructed that it was there on the presentation, which didn't come through. We, in fact, should have ensured that the presentation comes to us in advance. We go through it once before we allow the screening to happen. And that is something which we should take care going ahead.
My takeaway from this is that even though lots of participants have registered themselves, but they have not come up. So I think before 1 hour, again that say, what we say, reminder. I saw Gurleen's reminder again 1 hour ahead.
Yeah, 1:10 we had sent another.
Yeah, another one. But I think to whom we sent WhatsApp messages, no, that reminder can be sent.
I also feel that a couple of people are using the same device. Like in my office, I know that 10 people registered. All of them have attended also, but then they
Same in my office also. They got together and they were
together and see it from
so,
device.
Yes, that's another probability that we could see lesser participants. Because generally in a conference room, people sit together, 7, 8 of them, and they attend it.
True. So that is one of the reasons probably we don't have enough numbers here, but it might have gone to more than 200 people also.
Yeah, I hope so.
Hello, good start at least. Now,
both the registrations and the chat box response, everything has shown that the way we are doing is right, because we had some element of self-doubt over the last few months. So it's good to know that we are also on the right track.
Right, yes.
Self-doubt is good at times.
So next we're planning in the last week of November, right?
No, I think it's December 3rd week, right? Or second week.
Oh no, it will be.
Did we skip November in between? So December, okay.
December 15 will be a good idea because.
Post that people would start going on vacations.
Yeah.
The latest should be December 15th.
December 15th. Yeah.
Yeah. So that would be women in family business, right?
No, no, no.
No. It's emotional intelligence, emotional
Right.
ability
Sorry.
resources.
If we had the dates, we could have announced that today also.
Hmm.
Has she confirmed, Varsha, for December 15th?
Yeah, it is confirmed. I will convey her, and accordingly, the other planning can also be done.
Can you share her email ID? One official email has to go.
Yeah. Yes. I will share everything tonight. Is it okay?
Yeah, no issues.
Yeah.
Fully in wellness, Electrama,
Electrama is 2023.
2023, when?
It is not yet finalized.
Don't know the month.
Depends on the next pandemic, I guess.
Somewhere in January or February 2023. That's the right weather also, actually, you know, people to travel and all that. Okay, so I think what we can now do is, you know, before we have the speaker for emotional intelligence, we can at least, you know, send out one mailer after a few days talking about, you know, that this is the next program we're going to come up with. So a teaser, primarily.
Yes.
And I think, you know, then a week from, you know, the date we'll send the teaser, we should have some, you know, important details with us, as in if we have figured out who the speaker is going to be, etc., then we can start propagating it.
I will give you the short teaser on that, means the matter or the text, so that the proper mailer can be
Yes, absolutely.
designed by you.
Yeah, sure.
Just give me 1 or 2 days. I will.
Well, let's do it after Diwali, because now is the festive period. People might be on, because there had been a lot of them to whom I also sent across, and I got their auto reply back saying that I want to. Let's send it on, let's say, a 6th or something.
No problem.
Meanwhile, we'll get at least our, we'll have our homework done at our end.
No problem.
Okay.
Yeah. Great. Wonderful session.
Yeah, very good session. I just got a couple of things. Oh, not everybody is here. There is an organization called Catalyst for Women of Entrepreneurship, CW. So they have about 3,600 members. It's a membership based, they pay an annual membership or a lifetime membership. So they have a lot of resources in terms of whether it is for mentoring, motivational talks, or finance, compliances, etc. So there's a ready-made bank of trainers available there. And I was speaking to them yesterday. The lady who runs it, who started it, is a friend of mine. So she says that use their resources and rope them in for our programs. So we could just, like we said today, that it's IEEMA plus Prabhudas Lilladher. We can say IEEMA plus Women in Power plus TWD, Catalyst for Women Entrepreneurship, is jointly running these programs, which can be an address like today, a session like today, or it can be a workshop also. They can do 3-hour workshops, etc., on compliance, starting businesses, better managerial skills, soft skills, all of those things. So I think instead of us hunting for experts each time, it makes sense for us to partner with someone. Not only this organization, there will be many other organizations also, where we can draw upon their resources, so to help our membership also.
Good idea.
That sounds
Yes,
I can write her an email saying that yes, but there is no commitment from our side. As in when we see something good that we want to utilize from their side, we could do so.
Sure. That's a good idea, actually.
Yeah.
But otherwise, I think November, one more mailer will have to be a teaser, plus a recap of today required.
We'll be sending one thank you email up now to all the people.
and then the teaser, then the event for the next December. And Varsha's article. Journal.
Yeah. I will complete that and will forward by 15th of November.
Yeah, and the DG was also asking what is the plan for the next few months.
Meera, when
Again, speak from that.
hello, Meera, since Diwali is coming up, a special happy Diwali from WIP in the journals or the mailers. High existence. Really?
Yeah.
Please add it in the thank you note of today. Thank you for attending and wishing you all happy.
So let's do that. I guess once we send out this thank you emailer, let's send out our Diwali wishes in that.
Yeah.
Okay, done.
You look good
Yeah.
also.
Yeah.
Yeah, okay.
We'll do that.
Chalo, let's have some coffee now.
Yeah. Time for coffee, actually.
Coffee already.
Okay. Take care, ladies.
Yes.
Thank you.
Thank you.
very much.
Bye.
Congrats again.
Bye.
Bye.
Sonal.
Take care.
Take care. Bye-bye.